From the morning reading, SPX lowest close since August 25th. Microsoft, Intel, Amazon, Facebook, Google lead index lower. All 9 sectors moved lower on Friday. XLU, XLV, and XLP were the strongest sectors, while XLE was the weakest sector. Oil fell 53 cents to close at 30.68. Breadth weakened as decliners led advancers 4.73 to 1 on the New York Stock Exchange and 4.63 to 1 on the NASDAQ. Oil, China, and earnings were factors in the SPX falling to its lowest close since August 25th. SPY finished lower for the third straight week for just the third time in the past 54 weeks. The prior two times, the week of January 12th and March 9th, Spider closed up 1.66 and 2.68%. If that occurred next week, the Spider would end the week between 190.82 and 192.84. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:49 a.m. Central Time, and I'm recording this in preparation for the market day of January the 19th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive in on the morning report. And indeed, once again, the overnight action was a big night. And at this time of this cut, the S&P futures were up about 1.5%, or about 28 points. Taking a glance over my shoulder, yep, that's still holding up. Russell's up about 1.4%. NASDAQ is up over 1.5%, as is the Dow. In terms of crude oil, that certainly has been the leader up and down of late, and crude oil in the overnight is up some 2%. And remember, this is overnight as of the closing action of Monday. Futures markets were open on Monday for a half day, while the cash markets were closed for the trade holiday. So compared to Friday's closing action, these numbers may be a bit off if you're using that as your reference point. Euro is down about 1/3%. Bonds are down about 0.6%, and gold is down about 0.5%. In overseas action on Monday night, you had China up over 3%, Hong Kong up over 2%, Japan up over 0.5%, Germany up over 2%, as is the United Kingdom. In terms of macroeconomic reports for the U.S. on Tuesday, really don't see anything of note. One yellow flag report. So very, very quiet day today from that side. In terms of tomorrow, we have building permits, CPI, housing starts. So a little bit of activity for tomorrow, so we'll keep that in mind. In terms of current market conditions, certainly we have had volatility of late, and you have the short-term VIX just under a 30, skew very elevated, over 145, and really that's the highest bracket we even track, is anything over 145, so that's as high as it basically gets. IV percentiles nowhere near as high as they can get. They're basically middle of the road. SPX is at a 52, the Russell's a 59, NASDAQ a 53, and the Dow at a 60. You see, we put in another standard deviation move on 3 of the 4 indices on Friday, and the NASDAQ had a 2 standard deviation move. And it's of note that out of a 3 trading session cluster, two standard deviation moves and one standard deviation move on that market. So NASDAQ has definitely been a very hot place, but all the indices have been quite active in recent trading sessions. So nothing calm about the market these days, and that itself should be something to tell you about what's going on. In terms of the charts, and I'm going to go ahead and go to the futures. Here's the S&P futures. Because we've had so much action, you see the very important price action that we have had here of late. We undercut this critical swing low We do have on the futures market a August swing low down here at 1831. That was still some distance away, probably about 18 points. So anyhow, with yesterday's futures action, you had a little bit of a doji-like body, and then of course this last evening coming into this morning, very bullish bounce forming. Now the question, of course, will be where does that go? We had what looked like a very bullish harami here, and perhaps you could even call that a piercing line. And that looked like to be setting up a reversal, just to have Friday come in and just totally obliterate that action. So in bear markets, you often will have big bullish bounces just to then fall down and leg down again. So this is very important to watch. This was a super important support level. If this holds and we actually get a higher high, and look how far you have to go to get a higher high. I mean, I guess you could call this a very modest swing high. So at the very least, we need to get up here around the 1950 area. So that's some 90 points away from where the support was. That certainly would be significant if we can get up to this level. That would be of notice. But after that, the next real swing is all the way up here at 2075. So that's just how much technical damage that has been done with this down move, and to actually break this trend and call something, at least in the short term, bullish and intermediate term bullish, you've got a long way to go to be able to recover that. So keep that in mind and keep that bearish posture in mind, even in the face of what could be short covering rallies and the like. So until this actually proves itself out, be suspect that this is just a bounce until you get confirmation. In terms of the Russell, let's take a look at that. Nowhere near the bounce in the Russell. And of course, the Russell has broken much more significant lows. It just cascaded through its August and September lows, and came down here to really a much, much longer term. It went past not just August and September, it went past the year prior October, barreled through that, and really I'm not sure that I'd make too much of this action here. Um, if you really get way back, there was a long-term trend line and a key moving average that came across this area. You might argue that that's what came in as support. But frankly, the only people who probably would have known that are the institutions. And of course, they do have the volume. So that may be the very reason. But the Russell is very, very weak. And even with the strength of the bounce on the NASDAQ and crude oil this morning, Russell doesn't seem to be participating. In terms of the NASDAQ, good bounce going on here. So this is mirroring more like the S&P. And then finally, the Dow, also very much like the S&P. So those three markets are moving in a pretty bullish move off of their relative support areas. Russell not participating as of yet. Let's take a look at the volatility. As you would expect, volatility is coming down quite a bit. Very, very high volatility action on the 15th. And then finally, bonds. Let's take a look at bonds. Bonds, indeed, as you would expect, falling off a little bit this morning. And indeed, in our room, we did a partial covered call in our TLT position, coming in at this kind of resistance area. So it makes sense in a lot of ways that we would get something of a bounce this morning, and then also that we would get something of a rollover on the long bond. The question is that it? Does that become the limit of the range, and then that's support, and now we go back well within the range and trade for a bit of a range market? Or is this just going to set up another bear flag on the SPX or the S&P broad markets, and we then roll down through that critical area of support? So big questions out there right now. That should be enough on the charts. Let's go to the daily guides. In terms of that intermediate term phase opinion, we still sit at phase 5. Now, if we get a break of diagonal support, we get confirmation, we could have this change. But as it stands right now, we'll sit with the phase 5, the break of horizontal and diagonal support. Certainly on the portfolio investor posture, these are mechanical signals and no real opinion there at all. IBD status remains market in correction. Accumulation distribution score actually got worse with the most recent trading action and fell back to an E on both the NASDAQ and the S&P. GMI index has retained its awful 0 out of 6, and that sell signal has been in place since 1210. That author is 100% in cash. In the decision point scoreboard, you see that we've had some further deterioration, and really we've got one lone green arrow, the NASDAQ long-term, which hasn't actually been supported by its PMO signal. Bottom line to all this is that we've been looking for this to start to stack and come into agreement. Well, if anything, it's coming into agreement to the bears. Now, we do have some neutral signs in here, and we certainly recognize that. But when you put all this together, consensus is clearly, while we might be still a market in transition inside a very large, about 200-point range, it is with a very strong bias to the bear side. In terms of the intermediate term market posture, that retains a very bearish sentiment line. And indeed, you see all 4 of the indices well under 20 and all in that severely bearish camp. In terms of position sizing opinions, you've got the one system coming in recommending a 0% and the volatility based system coming in at 50%. So that should be also another layer of warnings to you. Hedge warning status remains a threshold level 3, which is our crash warning. This is the potential for significant downward move and large moves exist in the marketplace. It's not a prediction that we're going to have a breakdown, nor a prediction of how far that might go, but it is a recognition that the risk to significant downward moves into the broad markets exist, and your hedging and your portfolio management should retain the connection with that kind of risk in the market. Now, we are set up for a bounce, and many of the signals are certainly signaling that in terms of the equity short risk. Short-term risk, it's actually only a 3, and the intermediate term a 2. So relatively low risk entries after having dropped some 15%. But the question remains, do we become 20% or even 25%? It's always better, especially if you're a novice trader or one that needs to protect your capital in a significant way without taking undue risk, that you look for confirmation signs of a bottom in place instead of getting in too early just to find out that it was another bear flag laid down. In terms of the special opinions and under the volatility, you see there's quite a bit of red down here. Market decline, sharp increase warning. VIX futures up over 18. Distribution day count is set in the market in correction status. We have a volatility ratio warning in place again. VIX has been increasing. Skews actually up over 140, about a 14% probability of a 2 standard deviation move in the next 30 days. That represents about a 7-fold over normal probability. The new highs, new lows, exceptionally high new low count, over 1,300 on Friday. In terms of the intermarket risk aversion indicators, all 5 are flagging as risk off. And then with the fear and greed index, we're in the extreme fear camp, a very low score of a 9, the previous close being a 17. So again, more technical damage was done on Friday. In terms of special opinions, all these systems are outside their acceptable window to initiate new positions for novice traders, and even more aggressive traders would be very well suited to be extremely cautious and defensive, and probably best, even for aggressive traders, to remain heavily in cash until we get something of a bottom pattern. If you choose to go in, use some of the defensive postures here that we talk about. For example, if you're going to take a position in something that you've been wanting to get into and set up a covered call, you might want to use low beta positions. You might want to use in the money strikes, take very defensive kinds of returns, and even better, consider legging into those covered calls by selling puts and then being willing to take assignment at that stock at a discount. So pretty defensive posture right now. And you can see why. Look at this market posture, with the exception of utilities, which is the defensive sector. It's a sea of red across all time frames in all other sectors. In terms of percent change, you see the 1 day. Friday was a very ugly day. This is not just red. These are red with big numbers. And then the 5 day, 1 month, 3 month, and even, of course, 1 year, there is a lot of red here. So you got to keep all this in mind. In terms of the relative rotation graph, it's about as ugly as it gets. We've got one industry group that basically is up here in this right-hand corner. We have IYR that's also moving up here, and an XLU that's moving up here. We actually, in our trading room, actually have positions in both XLU and IYR, so we're certainly glad to see that. But those are very defensive kind of positions. So while it's correct that we're in the defensive types of positions right now, that doesn't say very much for the broad market and its bullishness. You notice that this one that's been tailing down, but certainly is in the right sector, is the semiconductor index. That might be something to kind of keep an eye on in your watch list, especially if you see that the market confirms any kind of bottoming pattern. Okay, that should be enough for today. In terms of special opportunities, we've got a number of special opportunities. Our collaboration education partner, Nick, is offering this course right here, Self-Directed Active Money Management. This is on demand. Just go to the hyperlink and you can pick up more details about that offering. And I'll just roll through the others here. If you've got more interest, just pick up on the hyperlink and go for more details. Love this one, daily price guides, and very cost effective at $25 a month for an 8 market cluster. Covered call class, this one will start on January 30th. Just send me an email at steven@falconglobaltraders.com to get the registration form. Lots going on here right now at Falcon Global. And of course, we still are every day active in the trade room, where we model our actions from entry to exit on every single trade. If you find what you're getting here is helpful to your trading, we greatly appreciate you recognizing that and liking us on YouTube. Subscribe to the YouTube channel. That will give you a heads up when content is published. And you can pick it up once it's published. Wait a couple minutes, let it get fully digested and be available to you in high def. Once you then play that, you can change the settings and go to high def and even speed up the video so that you can listen to even a 20-minute video in something like 13 minutes and still understand the speed. Retweet us to your Twitter followers, to your stock Twitter followers, also greatly appreciated. The disclaimers, as always, hit the pause button if you need more time to review. And then down here, you'll see the full disclosures. Go to that hyperlink if you'd like to see all that legal jargon. So that should be enough for today. We'll be back here tomorrow morning with the Falcon Global Market Preview, and good trading to all.